for joining. Thank you for joining us today for Fame's Personal Finance Foundation's Part 2. My name is Steve Kautz, and I'll be taking you through a conversation today. And you might know something about Fame since you're joining us, but just a reminder then that the Finance Authority of Maine is a quasi-independent state agency working to provide financial solutions to help Maine people achieve their business and higher educational goals. And more specifically, for me as a financial education specialist at Fame, helping people work on their personal financial wellness. So today's topic is part 2, going from emergency funds and basic budgeting all the way maybe to thinking about investing. And if you missed part 1, don't worry, there will be a link in the chat. There'll be a bunch of links in the chat actually at some point. And one of those will be a link to part 1, which we did some months ago. And part 1 was really looking at some budgeting basics, building an emergency fund, and other foundational pieces of the personal finance puzzle. So if you want to watch that one again or go back, the link is there in the chat. And today we're going to go from that into what I'm calling part 2, building on that foundation, talking of the transition from the basics to actually saving and perhaps investing and watching and helping our money grow. Other foundational pieces. I hope today that maybe you'll learn something new. Maybe it's just affirming something you thought, and hopefully taking some action and continuing the conversation about personal finance. If you remember from part 1, or if you watch part 1, I'll tell a little bit more about myself there. But in short, I love doing this, and I do this job out of what came my own experiences, where I was not so good with money and had to get on a different path, was fortunate to do so. And for the last few decades have tried to teach personal finance, whether in school or through my work at Fame. And another way that I continue the conversation is through a blog that I do for Fame, which is really that, a conversation about personal finance. Different topics to explore, things that I've been through and lessons I've learned and continue to learn. This is never ending. Every day brings new challenges. Just when I think I may have something right, the situation may shift a bit and I may have to adjust. I'm still really exploring all the time and trying to make better decisions, modify my behavior, and pass that on in any way I can. So I do like to call it a conversation. To that end, please feel free to put questions or comments in the chat, and Mary will either send them to me in the moment if they seem better to answer then, or we'll get them done at the end. So some of the topics today, a little intermediate look at emergency funds and what those can look like and what you can do with that money. A little bit about debt and credit score and how those fit into the personal finance picture. A bit about that transition from simply saving money, moving on to actually potentially investing. Some notes at the end about potholes, things that can get in our way and derail us. Some notes about insurance as they fit into the puzzle. Economics, which to me is a critical part of our personal financial decisions to understand the world around us. A lot of talk about making the transition to getting our money to work for us. We are working for our money, and that's great. Something that took me far too long to learn is how to get my money working for me. I always thought it was something only accessible for people who were already wealthy or people who had a lot of money to invest. That is not true. We can all get our money working for us, and little steps along the way make a big difference, not only in our bank account, but psychologically to make us feel we're headed in that direction. And I'll be providing a lot of resources. There'll be probably too many links in the chat, but I don't want to leave any stone unturned. So we will dump a lot of links into the chat of things that I mention as I go. Just feel free to copy and paste those and save them for a time when you can go to them, because you definitely will not be able to look them all up at once. Like I said, please put your ideas, thoughts, questions in the chat. So the first thing I want to mention today is to look at the big picture and what I'm calling the sources of money, right? Where does our money come from? Well, for most of us, me included, it comes from labor, from working. But the other places that money tends to come from is from labor and from land and capital, sort of the traditional economic and financial model. We don't all have access to land that can produce money for us. I never have. And that maybe owning our home can be a good financial move, but most of us are not going to become landowners and make a lot of money from that. However, it is something to think about as to how money, where money comes from. However, capital, we do have access to something called capital, which is our money working for us, otherwise known as investing. But we're going to think about this in the big picture today. Right now, we're probably mostly using our own labor to generate our money. But what else can we do in our life to work toward that capital ideal? And this idea of, from the first part of this talk, a lot about budgeting and really just trying to get to the point where we know where our money's going, we're paying our bills, and getting ourselves on more stable ground. But when we're looking at the next steps, we want to start thinking about how our money can actually grow. And these are some of the pieces that have to be in place for our money to grow. For example, we really can't go out and be a successful investor if we're not on some kind of budget and have an emergency fund built up. We could invest, but if our investments don't go well or we don't plan correctly, we could find ourselves without the cash we need for our daily needs. So money can grow when a budget is established, a method of budgeting, knowing what it is you can and want to spend. An emergency fund is established. Insurances are in place. Debt is either being managed or there's a plan to manage it and hopefully eliminate it. Credit score, knowing where your credit score is, how to make it better so that you can get the most out of it when the time comes, for example, to borrow for a home. Savings and investing habits, getting those established and making it routine, making it automatic is something that has to happen before money can grow. And ultimately, it's about your money, your behavior, and your future self. This image at the bottom, at the end of the day, the money coming in has to outweigh the money going out. When that foundation is set, then we're in a position to take steps to make our money grow. Goal setting always has to be a part of this conversation. These can be goals for paying off debt, for earning more, for controlling spending, how much to save, how much to invest. The goals might, at the beginning, be daily. When I first started getting my financial house in order, it was a daily fight. I had a daily budget, and my goal was to stay under that spending limit for that day. Eventually, we might look at longer term, different types of goals. They have to connect to our behavior. If we set a goal to do one thing, but we don't put the behavior in place to make that goal happen, we won't get there. Budgeting helps. As I said a lot in the last session, the budgeting is sort of the financial mirror that tells us this is what you're doing with your money. Is this what you want to do with your money? And is this going to take me where I want to go down the road? And goals, really, you want them to be specific, actionable, something you can actually take movement toward, and measurable. Can you see the result? So a couple of examples in the intermediate personal finance world that you might be experiencing or might want to look at. Paying off a credit card balance in a certain number of months by one, not using it anymore, and two, by paying off a certain amount per month to get rid of that. That would be a specific, actionable, measurable goal. On the other hand, it could be an investing or savings goal. Cut $50 a month out of my budget somewhere. I'm going to stop spending money on this thing, and I'm going to take that $50 a month and automatically start depositing it every month into a savings or an investing account. So just a couple of examples of what specific goals would be and typical goals and when it comes to our personal finances. So kind of the first meaty topic today, detail, is that emergency fund reminder of how important it is to have an emergency fund established so that when something goes wrong outside of our budget, the idea of borrowing doesn't have to come into play. Credit cards and other types of borrowing that really eat away from our ability to change our financial situation and work toward better financial wellness. So the stages of emergency funds, however, not everyone's always in a position to put a lot of money aside. So think of it as stages. The first stage recommended is to work towards, through the steps we talked about last time, through careful budgeting and planning, to build up a $1,000 or $1,500 emergency fund, which is only there for those purposes. The psychological benefits really can't be measured. When you know that if something goes wrong, you have that money and you're not borrowing more or using credit cards and adding additional stress. However, is that enough of an emergency fund for everybody? Probably not. So depending on your situation, if, for example, other people are depending on you, or you're a homeowner, for example, have other types of expenses, you're going to look at the other stages of an emergency fund. The most common stage recommended is to have 3 to 6 months of monthly expenses on hand in cash, not in a drawer in the bedroom, but in the bank in an easily accessed a place. Like a savings account, a checking account, and later in a minute, I'll talk about other ways you might hang on to your emergency fund. A more advanced emergency fund would be 6 months of expenses and beyond. Again, depending on what you need in case there was an interruption to income or a major unexpected expense. Because these things do happen, but if we can prepare for them, they won't derail us permanently from our long-term financial goals. Last note on emergency fund. If you have your emergency fund established, ask yourself and your financial institution, is the place where I have that emergency fund the best place? An example, if it's in a savings account and it's earning basically no interest, perhaps it could be in what's called a high yield savings account, earning a couple of % of interest, or a money market type of checking account, which could earn a couple of % interest. You might have different blocks of your emergency fund. For example, an extra $1,000 or a month of expenses in your checking account. But if you have a bigger emergency fund, consider putting part of it into a certificate of deposit for 3 months or high yield savings accounts. I recommend asking your financial institution what they have for products that make sense for an emergency fund. The folks there are really knowledgeable, and they will generally have many products that can pay you more interest than you're earning today. And even if it's a small amount of interest, tremendous psychological benefit to see that interest come in on money that's just sitting there for emergencies. It's a very good feeling to have that and see that. So I recommend getting active with your emergency fund. Next topic of the day, credit. Just a reminder about credit score. The most common credit score, the FICO score, is on a scale of 300 to 850. There are a couple of arrows here. I mentioned these last time. The first arrow, just under 700, is where the average American credit score is, sort of a B minus type of credit score. Getting up to that other arrow, getting up into the mid 700s and higher, considered an excellent credit score. Okay, all of that's fine, but why does it matter? Well, I have this guideline. I'm not going to call it a rule, but it's a mathematical guideline that I keep in mind when it comes to credit score. And I like to get folks to think about this when it comes to credit score and why credit score matters. If you run the numbers, a 100-point difference on your credit score would typically mean 1% difference on money borrowed for a mortgage. 100 points typically means about a percent difference. Over the course of a 25-year mortgage, that is going to be $100,000, usually more, but at least $100,000 in interest. 100 points, 1%, over $100,000. It's worth it to work on your credit score, okay? I'll show you some of the categories here as to how to work on your credit score. We could spend all day on it, but to get you some idea, the best way to work on your credit score is to pay bills on time, because 35%, as you'll see on the graph there, 35% of your score is your history of payments. Have you paid on time? And immediately, you can start affecting your credit score in a good way by making your payments on time and getting that time accumulating. The way the formula works for credit score is exponential, and the longer amount of time you pay your bills on time, the more it helps your credit score. And as you pay your bills on time and hopefully pay off debt, it also can help your credit score because of amounts owed. The amount of money that you owe if you have credit cards or loans, the higher that amount is, the worse your score. So taking these steps of pay bills on time, being on a budget, reducing debt will all contribute to a better credit score. And I'll mention a couple of other things as well. And again, why does it matter? 1% on a mortgage can make a massive financial difference in your life. That $100,000 plus could mean the difference between no retirement, extra retirement savings, or a much better retirement savings. So it's very good to build your credit score. From wherever you are today, you can get on that path. Steady habits and time. This is what is rewarded on credit score. The other thing that is rewarded, because part of it is how many accounts you have open, a smaller part, but it still matters. Less is more when it comes to credit accounts. The more accounts you have open, the formula considers you a higher risk. So it lowers your score. Or if it doesn't actually lower it, it prevents your score from growing. It creates sort of like a ceiling in the way the mathematical formula works. So less is more. What I recommend working toward is having one credit card. If you're going to have one at all, have one. Use it only for budgeted expenses. Pay it in full every month. And ignore the points and the miles and the shiny objects. If by having one card and using it for budgeted expenses and paying it in full, if after 6 months or a year you get some bonus points or something that you can use, that's it. It's a bonus. But don't pursue, my advice would be not to pursue credit cards or those types of accounts for gaining those things, because they are typically come-ons to get you to spend more. And that's the opposite direction of where we're working. So less is more. If you have multiple credit cards, and first of all, you'll want to pay those off in general. If you cancel a credit card, does it hurt your score? A little bit, but time and steady habits is much more important than canceling a credit card. So work to pay off those other accounts, go to one card and use it in that way. And over time, that is the best way to build your credit score. If you have other loans, like a car loan, of course, pay it on time, work toward paying it off, and reduce the number of accounts that you have in your name that can be considered a risk. Now, there are well-documented arguments against credit score from some very good and popular financial advisors. And I hear those arguments that we should just pay for everything in cash and not worry about our credit score. I disagree. I just don't think it's very easy to operate in our society without a credit score. It's very hard to save enough money to buy a house in cash. It's hard to save enough money to buy anything in cash, really, but especially a home. So I understand that argument, but I don't think it's very practical. So I'm more in the school of use credit score to your advantage by building it, and using, again, one card, use it well, pay it for budgeted expenses. Use my credit card for just that, things that are in my budget. And if it's not in my budget, it either has to come from my emergency fund or from somewhere else in the budget. I just don't impulsively say, I'm going to do this thing. Now, that gets to behavior, and behavior is going to be a theme today. So the connection to financial wellness and building wealth is how using credit to your advantage can really help you when it comes time to borrow, typically for a home. I can't recommend borrowing money for a car. I'm actually going to recommend trying to get yourself out of car loans as a way to build wealth. But if you do have car loans, or if you feel you're in a position where you do have to borrow money for a car, that is another place where a better credit score will get you a better rate, and that in turn will save you on interest. Let that breathe for a moment. Again, thank you for being here, and if there are any questions, please put them in the chat. A few comments on debt. Is there such a thing as good debt? Because I'm always going to say, try to get rid of your debt, get rid of your credit card debt, pay off car loans, don't take on debt. But debt, there are types of debt that don't have to be bad. For example, what you want to think of is the thing that you're borrowing money for. Does it go up in value or down in value? If something goes down in value, like a car, like a piece of furniture, like most of the things we buy, if a thing goes down in value, it is mathematically and financially a bad idea to pay interest on that thing, to borrow money for that thing. Now, arguments for cars, we have to get around. Cars are expensive. There are nuances to this. And sometimes some of us, including me, have to borrow money to have a vehicle for our jobs and for our livelihood. But minimizing that and working toward the point where you have enough savings where you don't have to have car loans is a very important component to financial wellness and to having your money grow. The other way is always working against you. Whenever that interest is eating away at your investing or savings potential, that's not going to help you move in the direction that you want to move toward. So good debt, something that goes up in value, like a home. That's typically thought of generally as good debt because homes typically go up in value. Not 100% guarantee, but most of the time, homes go up in value. Debt management, there will be a link before we end today, probably later on. If you do have trouble with debt management, there are services available to help you. If you feel you're in a more critical situation managing debt, there are There are methods, sort of like the debt snowball, pay off the small one, then pay the next one. There are other methods as well. But if you are in more of a crisis mode, I will provide a link there for some help. You can also email me to follow up and I can get you into the right direction. Big danger for debt are things like store credit cards, payday loan services, rent to own, and as I mentioned, car loans. Those are typically the most expensive. We're the most vulnerable to those. They're incredibly profitable for the companies and the organizations, and that doesn't obviously help us. Quick student loan conversation. It used to be very clear in what I do that student loans were debt that should be paid off as quickly as possible. That conversation is definitely changing, but the landscape of student loans is changing, as you probably know. I think the best thing to do with student loans is to make sure you are up to date on the latest programs available to you and to find out if it makes sense to pay your debt, your student loan debt, as soon as possible, or to try to extend it in case you might be eligible for a form of debt forgiveness. This is a changing landscape. So whatever is out there now, there are some need to be flexible. However, there are also some principles that are probably not going to change. And luckily enough, FAME can help, as well as going to studentaid.gov, where you can analyze your loans and see which payment plan is best for you. And then if you need more detailed advice, feel free to contact, you see the email address there, fame@freestudentloanadvice.org, where we have contracted with some of the absolute top experts in the country to provide student loan guidance and counseling. So student loans, education is wonderful. It can be thought of as an investment and something that is more valuable over time. How much we borrow is a very complicated conversation. It should always be minimized wherever possible. And if you do have student loans, deal with them in the smartest way for you by getting on the right program, making your payments so that your credit score is not negatively affected, and work toward eliminating that debt. Connected to debt, connected to everything we've said so far in terms of where our money goes and how to redirect it, is something I call the monthly payment mentality, and really trying to break the monthly payment mentality. We are conditioned, and I don't mean paying the electric bill, I mean paying for borrowing on a monthly basis. We are conditioned that things are so much per month. A car loan, so much per month. If you do go to a car lot, every time I've ever been to a car lot, the first question they ask me is, what kind of monthly payment are you looking for? They don't really talk about the total price of the car. And we really should be looking at the total price of a thing and saying, can we afford the total price of this thing? But we are conditioned to think of monthly payments, breaking it down into monthly payments. And before you know it, we have so many monthly payments. We started out with just a few when they were small. Then we find out they're eating up so much of our budget, and they can be harder to get out of. So I say try to break that mentality by, one, not taking on any more monthly payments. And then when we can cut a monthly payment or eliminate a monthly payment, redirect that money and do the same thing with savings. So I would love for us to be conditioned to automatically save rather than automatically spend. So let's do the same thing with our savings. I wrote a blog post on this, which will be in the chat with a little more detail and some personal experience. It's completely connected to our budget, trying to find those small amounts that we can actually cut and then redirect into automated savings where we're paying ourselves. I just said that, pay yourself first. Let's talk about savings. Once we've got these other steps in place, budget, emergency fund, we really want to look at trying to put money away for different reasons. Short and medium term reasons, which could be education, home, a car so that we can avoid the monthly payment of the car and we can pay for it in cash or mostly cash, et cetera, et cetera. There's we use it at Fame too, and I use it everywhere I teach, thinking about this 10% idea of pay yourself first. Always pay 10% of what you make into savings before you spend your money on anything else. We can't always hit the 10%. There are times in our lives where, we're barely able to pay the bills and we're not saving 10%. There may be times when we can save more. But if we always kind of keep that in mind when we look at what we're saving, if for younger folks, if you save 10% your entire working life, you're going to be very happy as you get older. For someone like me who got a late start and had to undo some mistakes, 10% was not enough. I had to save more, and I'm trying to save more when I can. But for my son and for the students I teach, and I really talk about having that ideal of 10%. In there. I see the comment about debt management link isn't working. I will look into that at the end, Camille, and try to remedy that. So getting started, very important. Kind of like with credit score, steady habits and time are your friends when it comes to saving. Okay. Next idea about saving is connecting it to retirement. So again, those other things are in place, your budget, your emergency fund, and you're starting to save. And one of the things we save for, of course, is retirement. And there are different categories of how and why we save for retirement. We can do things on our own, where I would say the first, very important is to just get started and to do something, even if it's small. And connected to what I said about monthly payments, automate some savings, automate something, some amount per month automatically comes out of my checking account and goes into a savings account. And then maybe I can put that into a CD, and at least I'm earning a few percent on that. A little more advanced is looking at tax advantaged retirement savings, which for individuals would usually be an individual retirement account, or IRA. The two kinds are a Roth and a traditional. There are advantages to both, depending on your goals, your age, your income, tax brackets, and so on. So it does take some research into those details. If you open an IRA at your local financial institution, they typically have people on staff who can give you the rundown on the latest with all of the laws regarding these, but they're wonderful products. The Roth IRA is by far the most flexible, individually accessible retirement type product. The Roth is very flexible. So that's definitely one that I try to put on people's radars when they're really just getting started, whether that's my younger students or anybody that I talk to. So that's again, and then if you're also on your own, you're self-employed, there's something called a self-employed IRA for self-employed people or for who have employees. And that can be a tremendous program if you're not getting my next bullet, which is employer-based programs. So we can do some stuff on our own. Ideally, we would do both. We would do stuff on our own and have stuff from our employer. Employer-based programs, typical names that we hear of, the 401k, the 403b, there can be others as well. The details you'd have to find out from your employer. What is the retirement program, contribution program available to me at this employer? But the question I want to tackle is, should you take full advantage of your employer program now, which connects to our topic of the day? Are you ready for saving and investing? And the thought that I want to get across is that if, just like with investing or savings, if you're still managing car loans, credit card debt, other types of consumer debt, not your house, not necessarily your student loan, again, that depends, but if you're managing those other types of consumer debt, there's a pretty good argument that you're not ready to take advantage of your employer's retirement program, because you really should pay off those debts first. Every situation is different and it takes some analysis, but it is something to think about. For example, should I put 5% into my employer retirement program because my employer gives me 5% if I'm still paying hundreds of dollars in interest on a credit card? That's an easy one. I'd say, no, you're not ready. You need to pay those credit cards off, stop paying interest. As soon as you're done, you can throw all of that money into your retirement program. So again, there are nuances, but big picture, you have these things to consider. Am I ready? Just because the program is there, should I take full advantage of it? Now, if you have your budget, your emergency fund, and no consumer debt, absolutely you should take advantage of employer-based retirement programs. Research those and see how to take advantage right away. And then also, I'm providing a link to the Social Security Administration, which is really fascinating. If you've never done it, go to that link and it will tell you what you're earning, what your potential Social Security income is at different ages based on where you are in your working life. And if you continue to work or if you stop working, if you take full retirement or early retirement, it's really fascinating to look at those numbers in terms of our overall financial picture. If you're quite young, if you're 30 years old and you think it's so far off, it's still really interesting to see what you've already have there in terms of potential Social Security benefits. If you're getting closer to retirement, it's definitely a place you want to look to see what your expected monthly payments could be based on your retirement age. A wonderful resource that I feel everybody should look at. Okay. Now, to the why for a minute, the why and the how. Saving money for retirement, or really for any purpose, but saving money over time. And why are steady habits important? Why is investing potentially so important? I'll give you some graph here. This is an example of taking $150 a month for 30 years with conservative returns of 6% in, let's say, a mixed investment, including stocks and other types, sort of classic mixed investment. What's important here is, yes, 151,000 would be there after 30 years. That's important. The most important concept I'm trying to get across is look at the color in the graph. The green represents the money that you've put in over the 30 years. Notice how about 2/3 of the way through the graph, the yellow, which is the growth or the interest, has overtaken the amount that you are putting in. This is the power of money working for you over time. This is what I talked about earlier, capital, investing, having that money start to work for you harder than just the money you're putting in. And it's really interesting to see. This happens at any amount of money over long periods of time. The amount of the growth in the account overtakes the amount that you put in. And again, these are conservative returns of 6%. Typically over 30 years, many people see higher returns in standard investments accounts. Safer, less risk accounts may pay less, but you still see this effect of compounding over time. So that's the why. Now, where to get $150 a month? Not that easy, right? Well, some of the things I've touched on already, and today as part of our intermediate personal finance steps, these are really important. There are a lot of places that I recommend looking for that $100 a month, $50, $150, whatever the amount may be. Looking at our budget, some really classic places to look nowadays that I find the easiest place to trim some money from budgets are streaming services and phone plans. I recently cut back on a couple. I don't have many streaming services. The average American has 4.3 and spends over $75 a month. I was more like 2.3 and $50 a month, but I was able to cut that down by taking the Netflix account with ads. And the ads don't bother me, and it saved me about 20 bucks a month. I did something similar with another one, and I immediately turned that money around into an investment account. And it feels great. It's not a ton of money, but it just feels great to know that I made that decision. And I don't miss the Netflix without ads at all. And I'm really glad to see my money growing in that account. Phone plans are always changing. I think there are plenty of ways to save money, not only on the plan, but the type of phone. However, it requires sacrifice. Um, I I like to have fairly inexpensive phones myself, but they do everything I need to. And I have three family accounts, 3 phones, and we only pay about $70 a month. Most people I know are paying $70 a month for one, and they often don't realize what they're paying for. So it's a place to investigate. Do I need that much data? Do I need this? Do I need that? Or can I get a better deal? Other places, the obvious, going out to eat is incredibly expensive, more so than I've ever seen. So it's a great place when you're trying to cut, if you want to do things for your future self, places like that. The gig economy, side jobs is more popular than ever. So maybe raising some money, because you either have to raise income or cut expenses in order to attack that $150 a month or whatever your goal may be, paying off debt, investing, etc. Reviewing insurances is always a good idea to make sure your coverage is correct, but it's also a place, these things kind of build on each other. Once your emergency fund is in place, you could look at raising your insurance deductibles from $250 to maybe $500 for a deductible. Yes, you'd have to pay more if something happened, but the lowering of your insurance premiums can be quite dramatic, really significant, and a way to immediately funnel money into something else. Now, those items will typically give you smaller savings that maybe you could chip away and get $100 a month going in another direction. The big ones are going to be the car, your housing situation, paying interest on your debt, and ultimately our consumer behavior. Are we balancing our wants versus needs? And are we thinking of our future self and our goals? And that only you can control. And I can only tell you it does get easier. And the rewards for making some of these decisions and seeing your money grow is awesome. So many things to consider, again, from small amounts to bigger amounts, but they all can help you work in that direction. Investing. Obviously a huge topic. I'm not here to recommend any particular type of investment, but I am here to say that investing is important, and there are many different ways. For example, taking advantage of the relatively still nice rates at the local banks in a CD can be a way of investing. Looking at accessing the stock market or bond market and others are ways you might invest. But the things you have to think about is knowing yourself, knowing how much risk you're willing to take, understanding these investments. Accessibility. These are accessible to anyone nowadays. Opening accounts that are connected to the stock market used to be a pretty big barrier. You know, when I was younger, having to have a certain amount of stock and go to somewhere to open an account and have a stockbroker. And nowadays, my next slide will say the good and the bad is you could be investing in the stock market in 15 minutes. And that's not good for everybody because some folks maybe, and we'll talk about this, maybe some folks are not ready to be investing in the stock market. But if you think you're ready, it is accessible. The barriers are really not there like they used to be. And FOMO, fear of missing out on things when it comes to investing. I would say the only good FOMO is my kind, which is faux FOMO, where I actually have fear of having the fear of missing out. In other words, I don't want to jump on something just because everybody's talking about it or it looks so great. That doesn't fit my risk profile and doesn't fit the kind of risk that I want to take. I say that on the investing page because that is where it seems to happen the most. The biggest example are things like cryptocurrency or a particular stock that looks hot in the moment. So a little educational word on stock investing that I think everybody should be aware of. If you do think you're at the point where you are doing some investing in the stock market and trying to learn more about it, it's really important to know the difference between individual stocks versus funds. Think of an individual stock as an apple, one piece of fruit. Think of a fund as a basket of fruit. You can invest in these baskets or these funds. And what's really good about that, what makes that so attractive, is any given apple could be bad at any given time. But when you get that nice basket of fruit, one of the pieces of fruit might be bad, but chances are the rest of it's okay. That's how it works with individual stocks versus funds. On any given day or year, one stock can be incredibly volatile. But when your money's invested in hundreds of stocks, for example, chances are some are up, some are down, and you can chart a more steady path. I say this in a week where the stock market has been incredibly volatile, but if you look at the history of the stock market and take any 20-year period, you'll always see very solid growth. And it's not a mystery. The stock market is based on the performance of the American economy in general. So investing in the stock market, shorter term, higher risk, longer term, the risk is more spread out. But the idea of investing in the overall US economy, history has said, has been a good one. And of course, there are other ways to invest as well. And knowing your risk level is key. But very important to understand the difference between individual stocks and funds. And then the big question, are you ready? So you're on a budget, emergency fund established, and I would say the bigger emergency fund, 3 months to 6 months of expenses, debts paid off except for your home and maybe student loans. Is your credit score where you want it to be, or are you on the path to improving your credit score? Are your insurances in place the way you need them to be? Are you saving for your short and medium term needs in a more a way like in bank accounts, for example, where it's relatively safe, lower returns, but safe? Do you understand yourself and your risk and why you want to invest? What am I investing for? And are you at a point where you might need professional support to help you get invested? Now, if you do open up an online account, one of the really accessible features of these online accounts is something called robo-advisors, where the artificial intelligence advisors can ask questions and respond and chart investments that make the most sense for you. Really pretty fascinating stuff. But you may need an actual professional investment help. You can always email me and I can direct you to folks that would be appropriate for your situation. But a lot of people are investing on their own nowadays because of the accessibility to the market. We put a link from detailed advice from the SEC on beginning investing as well. As I said, it's good and bad. It's relatively easy to get involved in investing in the stock market in particular. I'm looking at the question. I will circle back to your question in a bit. I want to finish on this topic and I will circle back to it, so hang in there. So the mechanics of investing, again, it's very easy to get involved online. There are many companies. Robinhood is probably the most famous nowadays, but your Vanguard and other types of companies, Merrill Lynch, E-Trade, all have very easy to use platforms for investing if you think you're ready to invest. You want to think about the amount that you're ready and able and willing to invest, the regularity, again, how much risk you're willing to take, and your strategy. Are you looking for 5 years, or are you looking for retirement or something in between? Okay, insurance. I'm just checking my time here. I have about 10 minutes and I should be okay. Insurance. I will answer this question now since it's on the topic. The American Express high yield savings account I don't know the particulars on that account. I can only say that, American Express is obviously a large, well-known company, financially secure. That would be in your favor. What they pay for an interest rate, I don't know the current, but generally, online banking is going to pay higher interest rates than your local bank, but then you're sacrificing that local connection. For myself, I've tended to take slightly lower rates so that I can walk down the street into my bank. But I have also had an online CD and it performed very well and paid very well. So you want to know the interest rate and your accessibility for that account. High yield savings is very liquid. High yield savings accounts, the rates change, it's variable, but there's no term limit. So you don't have to leave your money in there for 6 months, say. The big decision you'd be facing is you don't have a building to walk into if you did an online account. And that's a very personal decision. But those are the things you'd want to consider. So a quick mention on insurance, the main courses, auto, home, renters, and life. And health insurance in our system is based for our employer. If you're not getting it through your employer, it is obviously a difficult and complicated conversation. But for auto, home, renters, we want to make sure we're protected at the levels we should be. I always recommend contacting a licensed agent in your area to analyze your coverages. In terms of what kind and how much, again, an agent can help you through that. I can also give some advice on how to find a good agent or research this as well. If you email me, as well as the state of Maine has a lot of information on insurance. Deductibles are really becoming more and more important because you can really cut your cost of insurance by raising your deductible, but then you're exposing yourself to more risk. So you do have to have an emergency fund in place. I recommend higher deductibles because you're less likely to make a claim on your insurance. And if you make claims on your insurance, you're more likely to see your rates go up. Insurance is that kind of thing we pay for and we hope to never use it. And you'd say, well, it's a waste of money. Kind of. But that peace of mind and having it there for the big ticket item to protect us from real financial catastrophe is what insurance is there for. Ultimately, it's a cost benefit analysis. How much does it cost to get how much insurance? And am I okay with that level? And it's different for everybody. The side dishes, there's product insurance. I'm not a fan of product insurance in general. I'm very careful about product insurance. I'm not saying I never consider it, but I always say no and then read it very carefully to see if it's worth it. For me, a $100 piece of electronics that I buy, it's not worth it to pay $20 for any kind of product insurance. I'll take my chances with the warranty. More often than not, it works out. Those types of insurances are incredibly profitable for those companies. So they're not really good consumer products. Be careful with product insurance. Umbrella insurance is for higher liability levels, disability insurance, long-term care, very, of course, expensive, important pieces of insurance that are usually part of our employee benefits package. Ultimately, you have to get what you need because that's what matters. A quick word about life insurance, since that's one that's on most folks' radar. There are two main kinds. There's term and whole life, and these fit into today's talk because term insurance is really relatively inexpensive. Whole life does have an investment piece, but it's quite expensive insurance and not generally recommended by most financial advisors that I know. So be very careful when choosing your type of life insurance. And the question is, do you need life insurance? That's up to every individual. You have to ask, what am I protecting? Am I protecting? Are people counting on my income in case something happens to me? That might trigger a life insurance discussion. Again, contacting a licensed agent that is recommended is the best way to try to answer that question. Ultimately, it is a very personal decision, and what matters most is asking, what am I protecting? We are coming to the end. And I'm an economist by heart, so how could I not mention economics and how this all relates to personal finance? I did a talk last year on this, which seems pretty timely, and the link will be in the chat. You can also scan the QR code here from the screen, but the link will be in the chat, where I just talk about how some of these classic economics features interact with our personal finances and how knowing one helps the other. You worked hard for your money, get your money working for you. And the best way to do that is to be on the budget, have your emergency fund in place, look at your bank accounts, see if you can get more interest out of your bank accounts, pay down your debt, start working on a retirement savings, even if it's small, do an insurance checkup, do a student loan checkup if you have student loans, consider the externals in the economics, and ultimately connect with your future self. Are my actions today going to produce the results that my future self wants and needs? So a few quotes here, which I won't stay here too long because I want to finish up. I think one more slide left. But money is only a tool. I will read that one. It will take you to wherever you wish, but it will not replace you as the driver. This is ultimately a decision-making conversation. Watch out for potholes. Monthly payment mentality, too much car. Probably the biggest thing that holds most folks back from where they want to go is a big car payment. So try to really analyze that carefully in your life. It also affects how much insurance you pay. It's really the opposite of building wealth. So be careful with car, rent to own, store cards, budget leaks, economics, insurance, and lifestyle inflation. Spending a little more just because our lifestyle wants it is not the same as true inflation. So we got to be careful with lifestyle inflation. Another resource, which will be in the chat, is Enrich, which is a service that Fame pays for. So it's free for Mainers. Wonderful mini courses, articles, and other topics for your financial needs. You could probably find almost everything I talked about today, follow up and through Enrich. You just have to set up an account. It's free and it's wonderful. And these links will be in the chat. I have a link to Fame's general resources, credit and debt counseling, financial relief resources for Mainers, an online budget worksheet, more information about emergency funds, studentaid.gov for student loan management. Wow, I just made it, and I'm going to answer that question and any others here. So the question that came up before was recommending budgeting software options like Mint. Here's my take on budgeting software options. I'm careful about them because most of the ones I've seen are trying to sell you something, which is the opposite of helping you budget. So be very careful that they are truly free. I have found that the ones offered by financial institutions tend to be truly free because they really do want you to be on a budget, and possibly they can connect with your transactions. Third-party ones where you have to download, you definitely get into the risk of sharing data and exposing your information. I'd be really careful about those. I like budgeting organically myself on my own spreadsheet. We also put one in the chat, which is available online. In the first session we did a few months ago, if you go to that link and watch that, I talk about my own homemade spreadsheet, and I can send that to you as well if you email me. So there are plenty of really intricate budgeting softwares out there. I'm careful about them because a lot of bells and whistles, and they might not address the core thing. Are you trying to budget? Do you need something to organize your money, or do you need something to help you make better decisions? So that's just kind of a starting point for that conversation. Let's see if I have more questions. Insert live. Okay, there's plenty of resources in the chat. I did get that one on the American Express. I think I've covered the questions that are in there so far. I think another one may have just come in. Check that real quick. Yes, I did. Okay. Whew, I think it's 12. It's 1 o'clock exactly. How about that? So any more questions? Happy to stay on here and answer them. You can also follow up with me on email. I believe my email is right there on the screen and was in the chat. Okay. Thank you all for coming. Really appreciate seeing you here today and participating in this.